and welcome everybody to this call. So maybe let's jump into the presentation. I've got some slides to help set our scene. If we go on one more, just the quick agenda. I actually ditched the 2024 results. So I've actually put in, I'm mindful of the vote we've just seen, that's half of you maybe don't invest with us and maybe don't know us well. So I've swapped it out a little bit with some slides about who we are and what we do. The 2024 results are on the website, bankersinvestmenttrust.com. And really, I won't go into too much of them. A difficult year in the sense of two halves. First half, we did outperform global benchmark, and the second half, we didn't. Basically, with the US sort of election, so exceptionism and, stocks like Tesla going up, which we didn't own, took a bit of performance away from us in the second half. But there's a lot more detail online, so rather than waste time here, I'd rather talk about what we're doing and what we're investing in, our outlook and current portfolio positioning. So let's jump on one and quick sort of introduction for those that don't know us so well. And as Mark said, really, actually, the trust is an old one. It goes back to, it was launched in 1888. Gets its name not because of things it's invested in, but the people who launched it, which were a collection of bankers from a company called Williams and Glyn in the UK, based in London. And they were a bank, and the investment trust was launched basically to allow their smaller clients access to bonds, mainly some equities in London. So, and we're really pretty much doing that still today. So we're there for, for just over £1 a share, you can get access to a global portfolio of equities. So again, that democratizing investments, I think, for small investors is what we're all about. The trust itself has a twin objective: to grow capital above the FTSE World and to grow dividends above inflation over the long term. We're listed in London. We're listed also in New Zealand, oddly. New Zealand allows investment trusts to list there, and about 15% of our share base or our investors are based in New Zealand, which is great for them, I think. We've been there for about 30 years. We also had a lot of continuity of management. I've been in the seat here since 2003. My predecessor, Michael Moole, who some of you may have invested with at City London, and bankers, was investment manager from sort of mid-1970s. So sort of two of us carrying the torch for just nearly 50 years or so. The yield itself, not the highest in the market sense, but it's one of the highest ones in the global sector. US market yielding about 1% nowadays. It gets harder and harder to find income, but we're yielding about 2.3% there, and a long history of growing the trust's dividends. So let's jump on one more slide and look at some of our core principles, as I've called them, and say, I think we're one of the few trusts with a twin objective there of growing capital and income. I think it's been slightly more challenging in the last 2 or 3 years, a very sort of growth orientated US technology market where dividends really don't matter. But I think over the long term, if you look at any study over 30, 40, 50, 60 years, both growing income and capital does seem a long-term way to wealth accumulation. So I think we're still mindful of that, even though we've bent a little bit into the wind to accommodate more growth-orientated holdings, as you'll see sort of towards the end when we look at some of our key investments. But I think long-term, it's still the twin objective is very important for that long-term accumulation of wealth. Consistency, I've mentioned before. We've continued to stick to our knitting, equity investments in global markets for many, many years. And then balance, I think, is important as well. We're not, I wouldn't have said we were particularly known these days for being value, nor are we particularly known for growth. I hope we can bend between those two as different markets are driven by different characteristics. The US is overtly a growth-orientated sort of selection of stocks when I look at it in our portfolio, because that's been the place to drive best performance. When I look at places like Asia, you tend to see where actually value, has a place and actually performs pretty well for a lot of the time. Europe, again, bends and flows and ebbs and flows. I would argue the UK, probably more driven by that more value orientation there. So we've got this ability to shift a little bit in the parameters there. We'll look at the team in a minute. Very much global specialists, investing based in their regions. And then we're one of the longest investment records for dividend growth. City of London is just nicks our record by about 3 or 4 months um, with its dividend rises in June, but we've been going since 1966, increasing the dividend. I've actually taken the history back to the war, Second World War, that is, and we haven't cut the dividend in any period in that time. In 1966, a lot of trusts actually held dividends because of it was the year in corporation tax was introduced, and so it was a bit of a tricky year, paying a bit more tax, and so dividends didn't tend to go up. But it's a very long-term record, and we grew the dividends about 5% last year. So again, comfortably above inflation. And then finally, low cost charges matter a lot. So our management fee is tiered. So as the assets go up, the fees drop. But we've got an all-in ongoing charge. So fees and other costs, auditor fees, etc., all those sort of things is 0.5%. And our debt and gearing, which again we might touch on later, if any questions maybe, is an average cost of 2.7%. So what I like about that is it's almost bang on the dividend yield sort of the portfolio. So I think over the next 20 years or plus of those loan stocks that we've issued, all the capital growth and the income growth from this point should accrue to you as shareholders and not be consumed by interest cost. So if we jump on one, the team here, my role, I suppose, at the top here as lead fund manager, very much sort of regional allocation, trying to make sure we've got assets in the right places of the world, sort out the gearing, as I mentioned before, and challenging the managers to get the best performance and looking at the consistency of what they're doing and trying to avoid sort of unintended consequences of one region being overweight something and another underweight. So the differences of opinion, I suppose, trying to net those down. Below me, then we've got sort of 4 stock pickers really. I've done many of these roles myself over the last sort of 30, 25 years or so. But we've got Jeremiah sits in Denver, which is the main hub for Janus Henderson. We've sort of 30, 40 analysts based there looking at the US market. And he's got, as you can see, 27 years experience in US markets. Jamie Ross is here in London with me. Junichi is in Tokyo and Sat sits in Singapore, covering the Asia regions. So very much sort of long-term records there, experts in their field and located locally, which I think is important to really meet those companies, meet management more often, and really have a good grasp of what's going on and driving markets. Portfolio, as I mentioned, is all equity, just investing in mainly larger cap companies, if we're honest. With sort of that would be sort of 10 billion and upwards in market cap. And then, we're trying to hold the portfolio around about 100 stocks. We've sort of reduced this in the last year or so. Did a lot of research looking at I suppose you call it the tail of smaller holdings within each regions. And the analysis proved over sort of many years that really managers were picking good stocks, but we should have put more money allocated behind those ideas. So their best ideas, the biggest allocations, were actually where they were generating the most return. So we've cut back the holdings. We're reasonably concentrated in each of these regions, so sort of 20-ish, 25 to 30 holdings in each area, giving you that sort of 100, and really trying to follow, I suppose the one thing that defines us in terms of style, if you want to think of it that way, is trying to invest in companies with good cash generation characteristics. So either currently generating lots of cash or looking like you're seeing the inflection from investment to cash generation. So cash flow yield, which is a concept looking at cash relative to the market cap as a yield, is trying to find high yielding companies where the market's really not pricing in the cash generation. I've always thought cash is probably, of all the characteristics you look at in a company relative to profit, certainly it is a number that's less easy to manipulate, should we say. You can sort of see the drivers of why cash is building up on the balance sheet or declining. It's a hard number. Whereas profits can be quite heavily manipulated by a lot of accounting standards. So I think following the cash, I always call it, is a good strategy over time. Again, there are certain periods when it struggles a little bit, when the market's more thematic or wanting to sort of believe in the future very heavily and the benefits of things coming through. But I think over time, ultimately, good companies generate cash. And they've got I suppose, their future is defined by the dividends they can pay, companies they can buy, capex, and all again driven by the cash generated internally. So that's sort of the team really. won't labour too long there, and we'll look a little bit more at the outlook we're seeing. So if we jump on a slide two, maybe one more. I think the background for me for equities in the last, I suppose, post-COVID, the volatility we saw initially through COVID has been very supportive. So equities have been in a good place, partly because of government spending, but also because really inflation starting to bubble away again is good for real assets, of which equities is a principal component. So relative to the 30 years before that, when we saw sort of more deflationary periods and bonds were definitely outperformed, equities have had a much better time. I see some structural changes here, I suppose, relative to the last 20, 30 years. Long-term bonds yields, to look at, I'll show you those in a minute, to my mind, have clearly reset to a higher level. We see sort of shortages of labour ongoing there, declining birth rates. It's harder to move labour around the world. I don't see any of that changing, and that's leading to higher wages as labour shortages are coming through. The geopolitics has definitely got more difficult in the last few years. And again, I think the philosophical challenges between, I suppose, East and West and other regions is getting ever tougher to navigate. But again, that leads to challenges, I think, from an inflationary point of view. Supply chain reconfiguration, deglobalization peaked sort of 2018, 19. And again, tariffs, whatever Trump brings in that space is going to continue to be, again, an inflationary policy to my mind. And then, expansionary fiscal policy post-COVID. Governments definitely have got that fix of raising ever more amounts of money and spending it in their definite pet projects, which again we've seen printing money is inflationary. And finally, extreme weather events continue to bubble away. Global warming definitely behind a lot of those. And again, then the investment needed for net zero, if we do get there by 2015, is expensive. So whether we can afford it is a challenge. So these all, to my mind, relatively inflationary period. So I think my view or outlook is that we'll see 2% inflation as a floor, not a ceiling as it's been in the last 10, 15, 20 years. And so we're likely to see inflation, well above most central banks' target of that 2% level. So if we look on the next slide, you see that in very clear, stark contrast to the US 10-year Treasury yield. So most of my career here, from 1990 when I started, and 10-year yields were sort of 8-9%. But you see all the way down to, never got negative on the US, but certainly we saw that in Europe, negative interest rates on long-term bonds, and it's definitely reset upwards. As I said, I think the natural place probably for the moment is 4 to 6, unless we see a meaningful spike further in inflation. But it's not that sort of 0 to 4. It's going to be higher. And I think the consequences of this are being delayed. I think certainly companies in particular have been very good at terming out their debt, but it will come to pass that the cost of capital has gone up, and that'll make it more challenging for some areas of the market. I think again, positive for equities as long as it doesn't go up too high inflation, but it's sort of negative continues for I would argue privately leveraged equity, probably bonds, property. Although we've seen obviously repricing in the property space, but not always in the private space. So I think this is something to build into calculations. If we go to the next page, I think the big change we've also seen. Jump on a slide, please. It's really the fiscal position, and this has kept a lot of things at bay. This is the US, looking at the US government debt and budget deficit. And you can see COVID in the middle there. Obviously, as all across the world, cost a lot of money to support the economy. But certainly the US is under Biden has not shied away from spending money and borrowing increasing amounts of money. The last 2 years, I think the numbers roughly, the US has borrowed about $4 trillion and got real GDP growth increase of about $1.2 trillion. So 30 cents on the dollar return, pretty disappointing. So that's a sort of 7% deficit or so the last couple of years. That's very high relative to the last post-war years outside of recessions. Europe is a bit more moderate, sort of 4 to 5. But that's driven about 1.5% GDP growth. So again, still a pretty poor multiplier effect. This is basically mortgaging the future. But the consequences are going to come to roost in terms of higher rates and higher long-term borrowing, as we've seen on the previous slide. So again, it's something that's a slow burn. It stopped a recession, but I think the cumulative effect here takes ever more borrowing to get ever more results. We need to be mindful that this could come to an end, and certainly Trump is talking about that. We'll have to see the consequences of it. If you jump on one more, you had the US being the only place to invest for certainly 5, 10 years or so. But that exceptionism does come with a high price, and we can see the price to book here of US assets. Very efficient, managed assets. I must say, when you look at the Magnificent Seven, as I'll come on to, some of these businesses are incredibly profitable. So hence a high price to book. And the US market has the highest return on equity. But you can see how the rest of the world is eyeing that up, and I think the US has got where it has to by a lot of deficit spending, and also the positive effect of the economy growing helps a lot. So I do expect some of those countries on the left to, Japan is, we'll touch on that later, but is very keen to improve its return on equity and creep to the right, and one should see therefore a benefit from a better price to book ratio on that market. So I think a lot of these markets in the middle there have got potential to improve. They're not priced for it, as you can see here, as the US just seem to be priced for perfection. So we'll see how we go. If we jump on one more, the US has definitely been driven by, a small cohort of stocks called the Mag 7. For those few who don't know what those are, those are Apple, Microsoft, Nvidia, Alphabet, Meta, Amazon, and Tesla. So these are really effectively the largest 7 stocks in the US market. And actually, if you strip them out, the US market pretty much performed in line with Europe and Japan last year, rising about 13%. But with them, it's been a very strong price return there, as you can see. Second year really of this very strong performance. 2023 saw very much a massive earnings recovery in some of these names as they dropped. Some of them are speculative businesses. Nvidia saw its increase in revenue and returns, and basically they got very serious on jacking up returns. A lot of these businesses. Last year was some elements of that, still that earnings story, but a massive increase in valuations as well coming through, driving this return. But if we look forward in the next page, we look at the earnings growth we've seen. So just to be clear on this one, the first column on each of these is the Q4 sort of growth, I suppose, year-on-year growth in 23, and then second quarter 24, and then fourth quarter what we're expecting. We're just seeing as they're coming out currently. So you can see how those big 6, I've taken out Tesla, which does this makes relatively little money, but looking at the largest big players there, you can see how when you're growing at 68% earnings, you can see how you re-rate quite seriously. But so premium growth is declining. The rest of tech, as you can see on the next bunch there, in the US market is catching up. So 20% forward growth in the current set of quarterly figures relative to 15. But equally, the S&P, the rest of the US market, ex-tech, again from sort of no growth in 23, is picking up growth as well. So I think we'll see a change. So you'll sell off in some of those names. We can go into questions about what's been going on with DeepSeek and other things, but I think you will see a broadening of the market. So last year we saw was the narrowest concentration of returns that we've seen in 50 years or something. I think only about 25, 26% of S&P companies outperformed the index. I do think the fact that so many companies are growing, on a comparable almost rate with those large US names, should lead to a broadening and should lead to more a wider selection of stocks outperforming, which again should suit the banker's portfolio. So let's jump on one quickly and look at some themes, as I'm conscious of time and getting some Q&A. I think we're not necessarily a thematic investor. We don't sort of sit in an ivory tower and conjure up interesting themes, but the themes come through, I think, in terms of when these regional managers are picking stocks. So I've listed some of the stocks on the right-hand side in the semiconductor space. And I think what we're very excited about here is not really AI. in the sense what we're very excited about, I think, is that the capital expenditure on chip manufacturing is likely to accelerate for another 2 or 3 years, and big element of that is onshoring. So there's still some issues around all the manufacture of NVIDIA's chips is in Taiwan, and the politics that revolve around that country. Both Europe, Japan, China, and America all want to onshore more chip manufacturing, so that's going to be a big increase in capex. We've still got some big advancements in semiconductor nodes, as it were. So the size of chips are reducing as Apple is moving from sort of 3 to 2 nanometers. So as you do that on the left, you can see that it takes billions more to build a fab to generate that extra improvement in a reduction in size and hopefully speed and performance. And we're at some cyclical lows as well. One needs to understand in terms of industrial chips, autos, and other consumer goods. So again, we can see an improving trend in the next 2 or 3 years of reordering in that space. So a lot of what we own here, is into that space. Some of it is AI. Broadcom is a good example of where I think Nvidia's market share is going to be likely pegged back by what Broadcom does. But a lot of these others are other components and the manufacturing processes for semiconductors. So I think we're still excited about prospects there. Next one is electrification. You jump on a slide. Is again an interesting trend. I've put on the left here, looking at historical, which is the sort of green line of US power demand. It's been very flat for 20 years, and that's as basically the economy has grown, but the efficiency of LED lighting, all sorts of things, has improved. So there's almost no growth in electricity demand, and we're expecting that to accelerate quite materially. Might have to slightly review some of these numbers in the US post-Trump and his policies, but I think if we do talk ourselves globally, I don't see a change in trend in Europe in terms of climate mitigation, should we call it? So renewables increasing. That increases investment in national grids, and then electrification as we go towards electric cars globally should just continue to lead to big investments, I think, in electrifying countries' grids. And so a lot of the investments we've got, again, on the right, are playing into that theme. Power grid in India, for instance, Nari is in China, and then obviously National Grid, many of you'll know well here. So, again, a big investment theme coming out. But when we look bottom up, we just see some very exciting growth prospects at moderate valuations. Next is a bit of innovation, healthcare. We jump on. Again, a sector that's gone nowhere 2 or 3 years, sort of viewed as defensive, worries about rolling over of a lot of drug patents. But, the area has done very well for us, particularly, and many others. We own Novo Nordisk and Eli Lilly as the GLP-1s, so the obesity drugs there. Again, proving that they actually do a lot of health as well around the heart and other areas. So we see that as a particularly strong growing market. I'm not worried about the gyrations we've seen the last sort of few months. I think the volumes are going to come through very strongly, and there's a big enough market here for more than two companies to operate. But I think the market's underpricing. This is a good example where I think the market's focused too narrowly on AI in terms of the winners, because it hasn't thought about the industries that benefit. And if AI is going to take off, it'll be about wider industries adopting it. And to my mind, healthcare, the provision of healthcare as well as drugs and pharmaceuticals, is a clear winner, an area where AI could reform and lead to efficiencies, productivity gains, and new innovations. So again, an area that's not priced for it, but I think is some great opportunities. And then finally, Japan, which I might not labor too much, but I've been talking about this for some time, is we've seen increasing improvement in corporate governance. So the number of companies with independent directors, it almost used to be zero. It's sort of now a third of companies, 90% of all Japanese companies now have a third independent directors, and it's 20% have full independence and rising rapidly. So that's leading to harsher questions around cross holdings, around cozy relationships, and they still exist in a lot of industries. So this last year, we've seen the insurance industry really get its act together and start cutting a lot of the cross holdings and efficiency on balance sheets there. And we've seen a very improved return to us as investors in Japanese insurance. There's lots of opportunity in companies like Toyota to cut some of the cross holdings there and improve returns to investors. So as we show here on the slide, I think the key mine is a strap line. Over 10 years, the compounding growth in earnings has been about 7%. But for dividends, it's compounding at 9 and share buybacks at 17. So we're seeing acceleration of companies wanting to improve the balance sheet, improve return on equity, shareholder activism demanding better returns coming through. So all good news. Jump on one more, two more actually, maybe. Just look at the, let's wrap up quickly on the portfolio. I've talked too much, I think. But there's the top 10. Understandably, a load of tech names to some extent. We've got 5 of the Mag 7, although we're sort of pretty much in line benchmark with Apple. But the key overweights within there is really, I think the largest overweights are Amazon, where we're really quite positive. Alphabet we've been buying back into as well, which again we see a lot of the risks there beginning to de-risk a little bit in that stock, and it's been a bit dull for 6 months. Amazon, I think, is all about profit margins improving, growth in advertising, and you've got obviously the cloud-based AWS on the top as an icing. Microsoft, again, a little bit less about, to my mind, about Azure, but again, there's a nice PC cycle building. I think figures yesterday showing quite positive returns coming through in that side of it, and each way bet again on Azure, OpenAI, and then Meta is probably the next one that's just off the list. But we do seriously is number 9, which again we're getting more positive on. The obvious one we don't own is Nvidia, where I struggle with the price. I think there's also increasing competition going to be coming down the line, and therefore margins are likely to come under pressure. And then also, I think I'm getting a little bit worried about cash generation, increasing receivables on the balance sheet there, and reliance on basically offering chips for stakes in businesses. You jump on one more, we can see the sector allocations. So we're sort of broadly in line with information technology or tech. I think the key are overweights to me, in my mind, in financials. I think there's a key desire for deregulation, start in the US, and it likely to follow from that into European markets. So a lot of people would say financials are quite fairly valued. I don't think they are if we look back to prices that were achieved on these businesses in the 80s and 90s. Price to book can easily get over 2 to 3 times in good businesses, and I think deregulation will drive more growth in those businesses. So again, I have to be careful that we buy the right ones. I never like a bank going too quickly, but I think certainly if we can reduce its sort of costs and inefficiencies in the market and drive some top line growth, which is sorely needed, then I think we can see better valuations there. Continuing with discretionary, it's been a bit tough in that space, but I see that coming back. Valuations have come back a long way, and really where we're underweight is the consumer staples, where again I think they've taken too much price over the last couple of years, and we're seeing challenging volume growth, and likely to see market share issues there. And again in sort of energy materials, again 2 areas I think we're less favourable of, and we can maybe cover those in questions. And then on a regional basis, the US is a dominant stock market these days. We got a 60%. We've increased allocation sort of pre and post the US election. We do have a more favourable stance towards that market in the next sort of 5 to 6 months. But as I mentioned earlier, I think there's an element of mortgaging the future going on there in terms of issuance of bonds, and I think it's an area to be a bit cautious on over the medium term. But I think in the next 6 months, there's still going to be some positive wins and to keep that market going. I think I might stop there, conscious of time. Actually, sorry, a couple more very quick ones. Next one is dividend growth. There we go, just showing us the dark line. We had obviously a rise in inflation 22, and we've seen that come through in profits and our dividend growth. So we're now back above dividends. And then finally, the discount. I'm sure somebody will ask this. Preempted again. One more slide, please. I think bankers is like a lot of trusts, and certainly in the sector, are trading on a discount. I think we're about 9% today. But we've been steadily buying back shares. We bought at 5% back in 23, about 7, maybe 8 or 9 in the last 12 months. We're quite happy to continue accelerating that buyback, and we see good value. This reminds you, we were on a premium back in 2019 to 21 or so, and slightly before that as well. So I don't think there's any reason. Our assets are easy to value, not like an infrastructure fund. And the biggest sellers being private wealth advisors, I suppose. Understandably putting clients in sort of low coupon gilts. I think that story is sort of largely playing itself out. And hopefully they'll be back to buying good quality managed investment trusts in due course. So let's stop there. And Mark, happy to go some questions.
Super. Thank you very much, Alex. And we'll carry on the discount front because, yes, you're right. The most uploaded question is on discount management.
Yep.
The comment is that the level of buyback is clearly not sufficient to get us back to where we were a few years ago. What about a tender offer for 25% of capital? These things seem more effective. Have you discussed this with directors? And I would just sort of throw in my tuppence halfpenny worth that the discount is an industry-wide issue at the moment, and you can see in the graph that you just showed that it's the last 3 years where it's been there, which is consistent with the industry. And I think also, personally, I see more of an issue when a discount is associated with an underperformance. Your 3 years have been somewhat difficult, as you said. There's been a pickup recently, but your longer dated performance outstrips the MSCI ACWI. So I don't see you guys as having a combination of those two events, which makes it as critical. But nevertheless, fair question, and you certainly have enough assets under management to consider some form of a tender. So how would you respond to that?
Yeah, so if I tackle the slightly sort of middling question, I've seen, I've been managing trusts. Actually, I managed Hensai Income before this one, so since the mid 90s, and I've seen sort of two other periods. 99, 2000, as when investors saw other things to invest in and direct investments. As people went after the tech boom, they sold collective funds and discounts widened very materially. We then saw another period around the GFC, when I think basically people were just fearful of any market exposure and they raised cash. And I see this period a bit like that prior one, where actually I think a lot of, when I talk to wealth advisors, they're merrily buying stocks direct instead of collectives. They usually get burnt at some point. But there have been these clear phases when discounts across the board for all investment trusts have widened, not just a performance issue in one trust relative to others. So I've seen them before. I think they'll come back again. In terms of us, we started trying to, we thought we've been buying back, so no issue with buyback. We've issued stock in the past. We'll buy it back at a decent discount, and we've used about 5%. And then I said we used about 7 or 8 or something last year. We've accelerated that into this year. We've taken the power of a year to buy 15%. So I think I'd rather try and accelerate the buyback and see if that has any material impact. As you say, so far a little, but not a huge amount. So let's accelerate it first. And then if we need to, I'm not sure a clearing event of a 25% tender is going to have that. It might just reopen up another problem the other side. So let's try and accelerate the buyback on a daily basis and see if that has an impact. If it doesn't, we'll move to plan B.
Okay. Yeah, I think my point was about frustration, and I think if you do have the combination of underperformance, then you have shareholder frustration, and at that point, you need to think about a more nuclear option. But I'm sorry, I'm answering your questions, which I shouldn't be doing. The next question is portfolio related. There's a large concentration in US mega cap tech at the moment, at a time when there are ever more questions about valuation sustainability. Obviously, in the last week or so, renewed data on potential winners. Why increase the weighting on this part of the portfolio now? And I'm conscious you've spoken about this, but if you wouldn't mind just readdressing. Yeah,
well, we're about 18% in that Mag 7 complex, and I think it's 25% of my benchmark. So it's a huge number. It's sort of 33 or something of the US market. So we're technically underweight. And as I said earlier, we own 5 of the 7. I think Apple is sort of, we've been taking some money out of Apple. So we've been net sellers into that one. So although we put money into the US market, we actually didn't increase our exposure to the Mag 7 in net because we took money out of Apple and put a bit more into Alphabet. But the whole step, we put more money to the S&P X than we did into those Mag 7 names. So we are mindful. The questions are starting to be raised, and I think they will. They're still going to grow earnings quite well in the next 6 months, and I think we can talk more deeply if we want about the challenges in the capex program there. But I think when I look at some of these businesses like Amazon, it's less of that. It's when you look at the drivers, it's growing top line at 10, 11%, but then the efficiencies it's gaining in terms of distribution are continuing to cut the cost of delivery relative to the sales. So that's growing at sort of 3 or 4%, sales at 10. It's going to keep grinding out some quite nice numbers. And it's not an AI story. It's about the efficiencies coming through and the scale of that business. And who the hell's going to create another Amazon? It's just inconceivable, that size of the business. So, to my mind, anything on AWS is icing on the top of it.
Thank you. Slightly different direction question on the portfolio. In terms of concentration, the writer agrees with the overall approach, given academic research supports this conclusion, but there's a danger that you've also sold out of some cheap mid-cap companies at the wrong point in the cycle, given that mid-cap has underperformed large media over the last 5 years, large mega-cap over the last 5 years in particular. And the same point question on geography. Best performers are likely to have been larger US holdings, but that doesn't necessarily mean they will be going forward.
There's always the inevitability you sell something that you wished you hadn't. I think it's inevitable to sell something, but have we sold and reinvested in others that we're happy with? So I think it's an interesting question. Again, I think for us, I like to sort of think that hopefully we're a simple concept to invest in. So if you've got a client that says, yes, one of your investors, I really like small cap, then buy a small cap specialist. Don't buy somebody trying to be a small cap specialist. And there's some really good trusts doing that. I still think larger companies have access to cheaper credit, have access to some opportunities. Global opportunities that maybe some of those mid-sized don't have. And so some of the challenges of why they've been struggling in the last few years of labor, all sorts of other, the cost of, can they afford the cost of, what AI might bring in terms of productivity gains or automation. I still think that's sort of 10 billion upwards, which in the US is mid-cap, by the way. Got plenty of US mid-cap. Is likely still to be a good advantage, I think. But yes, we've sold out a few names. I've kept some interesting ones. Cranswick we still own. Intermediate Capital, which used to be mid, but have got bigger as they've done well. So we've not thrown everything out. And hopefully what we've kept, I think, should do well. And then I think what was the other one was about regional.
Yes.
I said clearly, I think, certainly for 6 months, I just see the US policy. Will we get some lower? If Trump cuts taxes down to 15, it is beneficial for onshore US. The first phase of tariffs will be beneficial to US companies, but will there be retaliatory tariffs down the road that won't be? So I think it's watching brief. But I did feel the sort of first 6 months of Trump's presidency would be very pro business, pro stock market, pro US. Stocks, I reserve the right to turn around the mid-year and say, right, it's all in the price, and we need to move in other places. So, but the portfolio is, it's I would argue it's underweight Mag 7 now, but sort of equal weight non-Mag 7. But that means we're slightly underweight the US in the benchmark, which is sort of 68% or something. I think is the US market. We're at 62 or something. So.
And I would add, I think that concentration, conviction are 2 reasons why one goes for an investment trust. I don't think one wants to necessarily see an investment trust anywhere near a benchmarks.
Yep.
Next question. We've seen companies like Taiwan Semiconductor share price rise significantly, while ASML hasn't. What is the outlook for companies involved in AI transformation from foundries, equipment makers, semiconductor manufacturers to some of the hyperscalers? And I know you talked about a little bit about the sort of potential user base, but this is more value chain, I think, question.
Yeah, so I think ASML and the thing there is very lumpy. It's a big machine, and it's very lumpy order books, and it's also when they get ordered in the life cycle of building a foundry. So TSMC is producing all of NVIDIA's chips and many others for many other companies, and Apple included. So it's in production phase. So as orders come through, cash is exploding upwards. So you can see why. We own that one. I think I've got that one as well. So we're doing well there. My argument with the others is, we'll see these foundries built, and in 2 or 3 years' time, we'll probably be talking about a glut of chips and the pricing coming down. Again, different time, different. That's where the beauty of these active investment trusts, we can switch around and find the opportunities there. But I think you've seen with ASML, I think slight downdraft in terms of Chinese orders definitely were preempting tightening from the US. So he's probably brought forward orders into 22, 23, and then we're seeing a slightly, probably just an air pocket in orders as they come through, we think, in 25. And that's what the company is telling us. So let's see how we go. And then, the other companies like KLA, very excited about that one. Again, all about as chips get smaller, KLA do a lot of the processes for, effectively checking the quality of those chips. So as they get smaller, the failure rate goes up. So again, having that extra layers is incredibly important to that business. So we should see as these foundries get built, get invested, the order books go up for these companies. So I still think we've got another 18 months to 2 years of strong orders coming through. And then we'll start to worry, no doubt. It's a cyclical industry. It's always price to book to bill, the order book against deliveries. We'll remind ourselves again, it's cyclicality, and that's not in the price of some of those names in the semi.
Thank you. Can you talk a little bit about gearing and how you gear, whether it's CFDs, bank debt, what you use, how you apply it, and level and trend now, please. And if they see you gearing up, is that a reflection of bullishness?
Yeah, so I think the secret with gearing. So these are investor trusts are corporate entities, so they can borrow money over the long term. And the key, really, I think, is always to have some very good long-term borrowing, which allows you to have some flexibility not to have to borrow when rates go up. And so over the last sort of 7 or 8 years, as those interest rates on that graph I showed you headed to almost zero, we were sort of pushing out our debt into the longer term from the short term, where we had a lot of short-term borrowings when it was very cheap. And so we've got, I think, the longest dated, it's called loan stock, the longest basically debt we've issued is out to 2045. And we've got some the next, into 30s, mid 30s, and out there. So, we borrowed over the long term. The average cost is 2.7, as I said, percent. So we got some quite low cost euro borrowings, which was quite good putting on. And that means we've got no short-term borrowing. So I'm not borrowing from any bank at the moment. I can do. And if rates come down, then yes, if they get below 3, we might look at borrowing again from banks. But at the moment, I don't need to because we pushed it all out nice long term. So if I'm fully invested, which is probably the normal, I think what you should think of us for bankers is we'd normally invest everything. So cash is for working capital, paying dividends and moving stocks and things like that. We'd be geared about 8.5 to 9%. So at the moment we're not far off that. I think sort of 6, 7. So that's just a case of, I think, markets having run up a little bit through that Trump election. And actually we've seen some prices, a lot of prices hitting all-time highs. We've just taken a little bit off. So I'm a little marginally cautious, I think would probably be my line. But not enough. I can go net cash. I'm very cautious, but we're not there. We still think equities will go up this year. We obviously had quite a good start to January.
Thank you. Question on your Well, there's a couple of questions that relate to your specific role. I think you got the JH research platform behind you. You've got 100 odd stocks in the portfolio. So the writer assumes that you're not specifically a stock picker. Is your particular role and skill theme selection or portfolio management, or how does it work in terms of divvying up the tasks?
Yeah, I've sort of given it to I've handed it over to the specialists. We go back. I've managed the UK portfolio and Asia and even Japan for a time. So I've got a lot of experience over 30 years plus of investing in all these regions. So I think therefore my role very much is over the top, really to get the best out of the team. Talk to them, share ideas between them, making sure they're understanding why we own things, what we're doing, and making sure they're keeping to the consistency of their style. So in that sense, I'm the sort of overseer for that. I'm the conduit to the board to make sure they understand what we're doing. Investor relations, as we said here as well, meeting investors, sharing the story, updating people. And then the four I showed you are, doing the nitty gritty of meeting a lot of the. I try and meet the companies as well. I sort of sit in on the company meetings. Certainly make sure I read the research reports, so have a good understanding of why we invest in everything. But they're living and breathing the daily gyrations and results.
Thank you. Coming back to the portfolio construction, there's a lot of US based in there, obviously, but the question is there anything in emerging markets that the trust has taken large position in or is watching closely as you get a decoupling of China and Southeast Asia in particular, and where we're looking to benefit?
Yeah, good question, that one. About it's probably 8 years now, 7-8 years ago, I did a lot of work looking at, we used to own chunks of things in South Africa. We did very well in the 2000s, and then Latin America. But it got increasingly tough to invest in these regions, and some of it was currency. A lot of it was, if I'm honest, sort of scandals and issues around corporate governance. And I did a lot of research looking at, and everything just basically turned up, said, just put your money in America. It's a lot better return for lower volatility and a better currency. And so we cut out, China's a different story, but we cut out basically all our emerging market in the sense of Africa, Latin America, before COVID, so 2017-18, and that's proved a good switch into America. China we overstayed our welcome there. We did very well again investing in Chinese A shares from about 2014-15. Had some wonderful returns, and I hoped that China would recover from COVID a bit like we all have, but they didn't. They took a very harsh view of COVID, continued lockdowns a lot longer than we expected, and then coming out of that, continued with sort of corporate purging. There are other issues. We can talk about property market, all sorts of things, but it just is an economy that hasn't recovered in the same way, and certainly from corporate profitability point of view, hasn't recovered. And so we're probably a bit late recognizing that, a little bit, if I'm honest, but we've cut that right back. We're about 1.5% or something in China, but a watching brief. I mean, I do think there are some interesting opportunities. I'd just like to see the politics between Trump and President Xi, how that plays out. It could go either way. And China, I think, needs to do a sort of TARP equivalent, if you remember that, in America, to solve its property crisis. So you need to basically take all the property debt out of the banking system and put it in a special vehicle to work it off and get the property market running again. So that's holding back, I think, the market. So watching brief there, but we've cut right back. We've got bits of Asia. We like bits of Asia, Indonesia, Vietnam, and some other markets there. So we're not particularly in the exporting story, but we're in the financials and some more domestic growth stories in those markets. So hopefully we've got some interesting ideas there. But long-winded answer.
Thank you very much. there's a request to see the 1, 3, and 5 year performance relative to the benchmark. I'm not sure if you've got that.
It's all on the website. I just again, I haven't got it in here because I just it
I was
keeps getting out of date, and I keep urging people go and have a look at the website. When I look at 3, there's a bit of a hole in the 3. Where 3 is where we've struggled a bit. When we're not an overtly growth. I'm not a tech fund. I'm not an overtly growth investor. I said earlier we like free cash flow growth, which I think over the long term does you well. But when the markets are very strong in a very small section of tech companies, we're going to struggle a little bit. I do need it to broaden out. And if we get that, performance will kick in quite nicely. So we saw around, say in the last when it went very AI back of end of 22, wasn't it, into early 23 and 24, that we just struggled a bit with that period.
Yeah, I was going to say the website is fantastic. There's an excellent interactive graph which gives you one month, 3, 6, 1.
Yeah, and it updates daily. So better than my presentation.
And it doesn't hide anything. It's share price, net asset value per share, and FTSE World total return in sterling. So it gives a very clear picture.
If you're a huge bull of AI in the short, I think we're probably not the best place. But if you're a huge fan of AI transforming other industries, which it has to do, otherwise where's the money come from? Then I think bankers is a very interesting play on that, because we've got solid investments and we talk to companies about which ones will benefit. And I think that's where I see a broadening. It can't just be this very small subset of stocks that are right at the core. I think it's going to broaden out, and I think that the news we've seen this week is exactly showing if you can reduce the cost of AI, by lowering the cost of models and other things, then it's going to benefit more companies, and that's what I find interesting in the next 3 or 4 years of investing.
Thank you. We're 56 minutes in, so I'm probably going to cut it shortly. But there is a question going back to your asset allocation. The increase of 10% in weighting to the US since the October results, and the fact that that's based on the outlook for the next 5 to 6 months. I think there's a sort of concern being expressed that might be sort of momentum style allocation at the tail end of a rally. So can I put that one back to you, please?
Yeah, so the year-end results, you saw we had a lot more cash. So about half that investment was me taking some cash on board ahead of the election. If you remember, 2 or 3 weeks out of that election, we were very much, it could be Biden again, could be some other, there's a lot of uncertainty. And I think markets, to my mind, there was a natural point to raise a bit of cash. So we did. But then having saw a more, definitely a pro business, I thought, hang on, I think markets can continue to rise with optimism. So a lot of that investment was just saying, look, cash earning, okay, 4 or 5%, but we've got more than that back in the last sort of 3 or 4 months. So I think that's been a positive decision. We're not big ones for moving large amounts of capital around. So I don't think anybody accuses us, when you look at our long-term history, of being momentum junkies in any sense. But I did feel when we looked at, we took a bit of money out of Japan, which has been the right move. It had a good run. So that was sort of, again, another 2 or 3% of the next 5 to go in the US. And I think we're still overweight Japan, but I still like the story, but things do run a little bit too far. So no, I don't think you won't see me with a totally different allocation in 2 months' time, but I'm reserving that right 6 months, I say, into the Trump. Usually we found this in his first period. You had a strong whoosh, as everybody thought it was an easy game, and court case. We've already seen the courts begin to stymie some of his policies, and maybe that happens again, and we need to broaden out. But we do need Europe to cut rates. We need European companies not to be the wrong side of some rather heavy tariffs. So again, there's a lot of interesting things could happen in the next 12 months.
So I have two questions remaining, which is quite good that we've got through them. But The first one relates to Europe, which you just mentioned, but it's more focused on whether or not, if we see peace in Ukraine and Middle East this year, that would tempt you into Europe.
I think the peace in Ukraine would be the key one. I'm not sure. In the Middle East, peace would be, all peace is welcome, but I'm not sure it has quite the economic impact that it's. We've seen the oil price hardly blip with the Middle East, but I think it will be material for Europe. Again, it depends on the type of ceasefire and therein. Does it allow Russian gas to come back into Europe? I honestly don't know. I think it's so we have to look and see what it means. But I think it's definitely a path to peace, the path to opening up Ukraine economy and things like that would be very much welcome. It takes a big risk off and does allow opportunities there. So I think that would be definitely a positive effect for Europe. Yeah. It's not priced in yet, I don't think, but let's see.
Fantastic. And from the same question, it's just slept in here. Are you feeling bullish?
I think I am. Yeah, I think I am. Markets were stronger than expected last year. I think this year, I think consensus is something like, again, another 10 to 12% growth. I'd probably dial that down a little bit, but 8 to 10. And where I see bonds still struggling, I mentioned earlier the inflationary trends not going away. I can see a point where the US rates go up in the second half of the year. It's not my call, but you could see how bond prices are really struggle. So in that sense of what else do you invest in, you can definitely make a case for gold, and I think you can make a case for equities. But yes, I am bullish.
Thank you. And final question, technical. The shares that you buy back in share buybacks, are they treated as treasury holdings, or are they retired? What happens with those?
They are currently going to Treasury. I think we are going to have a debate about what we do with whether it's just too much. There's an efficiency if we want to reissue them in terms of if they're in Treasury, it saves us money issuing again. So, but if there's what's the point if they're so high? So we will see, but they're going to Treasury.
Fantastic. Thank you, Alex. That's the end of our questions, and I'm going to release you to your evening. But
thank you, everybody.